Welcome to Looking at the Markets with David Modell. Today I'm going to give you my particular strategy for selling iron condors. And I'm sure somebody else has thought of this strategy somewhere, but I've seen a lot of YouTube videos and I've never seen anybody else recommend this particular strategy that I use for iron condors. And this is going to be an advanced video, so we're going to assume that you already have some knowledge of iron condors, all right? But basically an iron condor is just selling a call spread and selling a put spread. Now, most people sell both at the same time, the call spread and the put spread. But I usually don't do it that way. I will usually leg into an iron condor. I might sell the call spread first, and then if I see a good setup, I'll sell the put spread later on. Or I might do it the other way around. I might sell the put spread first, and then if I see a good setup, I might sell the call spread later on. But I usually don't sell both at the same time. And the reason is because a stock is not going to go up too much too fast and down too much too fast at the same time. It's going to be one or the other. Generally speaking, I will not sell a call spread unless a stock goes up too much too fast. And I will not sell a put spread unless a stock goes down too much too fast. And it's not going to do both at the same time, and so I'm not going to sell the call spread and the put spread at the same time. But I might do one and then the other. For example, if a stock goes up too much too fast and I expect it to retrace, then I could sell a call spread. And then later on, if the stock turns around and starts to retrace and go downwards, and it goes way too far down too fast, in my opinion, and then I think it's going to retrace back upwards, then I might sell a put spread. All right, so I would leg into it. Or the other way around. If I see a stock go down too far too fast, in my opinion, and I think it's going to retrace and start to come back up, I might sell a put spread first. And then if it does retrace, starts to go up and up and up, and up too far and too fast, then I might sell a call spread at that point. And that would be legging into, once again, an iron condor, all right? So I'm going to try to show that visually, what that might look like. All right, I drew a crude looking chart here, all right? And so this is the price of the stock, let's say, and this is the passage of time. And of course, you want time to pass, and you want to reach expiration if possible, okay? Now, a lot of people will, they'll liquidate their iron condor. They'll take off their position, when they achieve 50% profit or whatever. So you don't have to go all the way till expiration. A lot of people don't, and that's fine. All right, so let's say the stock price starts here, okay, and then you see it start to go up, and it just keeps going up without any break, and it's going up, really fast, okay, and you think, well, you know what? I don't think it's going to go up much more, okay? Because talking about probabilities here, of course it could just keep going up and up and up, but the probabilities are that it's going to get exhausted. There's going to be exhaustion, and there's a good chance that it's either going to go up a little bit more but then start to turn around, or maybe it'll go sideways, or best of all, it'll just turn around and just retrace and start to go downwards. Either way, you win. You only lose if it just keeps going up and up and up, all right? Which is kind of unlikely, especially after it's already gone up a lot really fast. Again, no guarantees. It could keep going up and then you lose money. So, there's always risk, all right? And if you, let's say you sell, okay, so you see it go up really fast and really far, and then so you sell a call with a strike price right, let's say right here, okay? You sell the call with strike price right here. And then now it could just keep going up and up and up, and you could lose more and more in money. And so this is selling a naked call, all right, or an uncovered call. And so let's say you want to make it a call spread, and so you buy a call here just for protection, okay, just so you have a limited loss here. All right, great. And so then let's say the exhaustion does start to happen. It starts to peter out, and then starts to go sideways. Great, okay. Maybe you could even take off your position here because some time has passed, and or you can wait until expiration, your choice. Now, again, it's gone up too far, so I'm not going to sell a put spread at this point because it hasn't gone down here, and I expect it to retrace. But what if it does retrace, and it starts to retrace really hard, really fast, and really far? Well, now it's gone down too far too fast. So now I can leg into an iron condor. I can, if I choose to, I can sell a put option here, let's say. And right now it's just a naked put if you just leave it like that, okay? So for protection, I'm gonna buy, if I choose to, if I don't want to sell a naked put, I'm gonna buy for protection a put option with the price here below it, okay? So now it's an iron condor, all right? And hopefully, since it went down now too far and too fast, too soon, hopefully it'll start to, might go down a little more, but hopefully it'll start to go sideways and start to retrace. And hey, you made it all the way to expiration. Congratulations. And now you collected a premium here on the call spread and a premium on the put spread, all right? So again, it's only going to do one or the other at any given time. It's either going to go up too far too fast or down too far too fast, not both. And so I'm going to leg into the iron condor, okay? And let's say, all right, so here's the beginning of the time period we're looking at. And let's say, all right, stock price is going along and then, woo, down too far too fast, right? I mean, it's just really quickly going down, and you're thinking, okay, this is getting out of control, especially if it's a good company, all right? If it's a company that you've researched and you know that the fundamentals are fine and this isn't a market crash or a recession or a bear market, it's normal market conditions, and you think it's going to retrace. Or at least, you know, when something goes down too far, too fast, too quickly, too soon, chances are it's either going to go down a little bit more but start to go sideways, or maybe it'll just go sideways immediately, or maybe best of all is when it starts to retrace and go back up, and that's normal. Again, no guarantees. It could just keep going down and down and down. The company could go bankrupt or whatever. So there are no guarantees. All right, but let's say it goes down too far too fast, and so you sell an option with the strike price down here. Okay, all right, there you go. And then now that's a naked put. You're selling a naked put, and you know, it could just keep going down and down and down the price, and then you're losing more and more money. There's a limit to what you can lose, unlike with a naked call where there's no limit. But still, you can lose a lot of money if you just sell a naked put. So let's say you make it a spread where you also buy a put option with the price down here, let's say. Okay, great. So now you've got a limited loss here. All right, and you know what that limit is. All right, great. Okay, so let's say things work out well, and hey, great. Okay, it starts to, the bleeding stops or slows down, starts to retrace. Great, and now you know, it's over here, and you could take off your position and just take your profits, or you can wait until expiration, your choice. But let's say, ooh, it starts to go up, but it goes up way too far, way too fast. It's just out of control, right? And you think, wow, it's probably gonna now either go sideways or go up a little more but not much, or start to retrace again and go downwards. Again, there's no guarantees. It could just keep going up and up and up, and that's why there's always risk when you sell options, which you have to be aware of. All right. But now you might want to leg into an iron condor again. Now you might want to sell a call spread, okay? Let's say it's right here. And then for protection, you could buy it. You know, you sold a call, but you don't want to make it a naked call necessarily. And so you now buy a call up here with the price up here to protect yourself, all right? Otherwise, if you just sold this call here, then it would be a naked call, uncovered call. So let's say you sell a call here and then buy a call with the strike price above it, and now you have a defined risk, and lo and behold, your prediction was correct, and it starts to go sideways, maybe even go down a little bit, and hey, you reached expiration. You win. Great. Okay? So that's how I leg into an iron condor. Again, it's only going to go up too far too fast or down too far too fast, not both at the same time. And so usually I'm not going to sell both the call spread and the put spread at the same time. All right, but if it goes down too far too fast and then later on up too far too fast, or vice versa, up too far too fast and then down later on too far too fast, I might leg into an iron condor there. And you could potentially double or almost double your profit potential that way, all right? Now, of course, you're taking some risk there. So do this really carefully. Don't do this unless you really know what you're doing. And you always want to study the fundamentals of the underlying equity, whether it's a stock or whatever, or whether it's oil, or whatever it is, okay? If it's a company, if you're selling a put spread, you want to make sure it's a really good company that's not going bankrupt. You want to make sure that you're not in the middle of a bear market or a recession, something like that. If it went up too far too fast, you want to make sure there's a reason you believe that it's going to retrace, or at least go sideways or go up, but not much more. All right. You always have a reason for every single trade. You know why you're making the trade. And with the call spreads and the put spreads, you're defining your risk. You're limiting the loss that you can take. All right. So that's my explanation of how I do iron condors. And I really appreciate you watching and listening to my videos. If you want to support my channel, sometimes I'll put out sponsored videos where I'm promoting or helping someone, a company, to promote an ICO or maybe a penny stock, a small company stock. And so that's a sponsored video. And if you just click on those and give it a thumbs up, leave a nice comment, that will help. It doesn't cost you anything. It costs you nothing to do that except a little bit of time, just to click on those videos and give it a thumbs up. And then you're supporting my channel. And I really, really appreciate that. All right. Another way to support me is to join my BitConnect team. I'm going to put that link in the description of this video for BitConnect, which is a way to earn daily interest. I profit every day from BitConnect, so you can join my team as well. So thank you so much. I really appreciate it. And you can email me anytime at davidmodell@gmail.com. Thanks a lot, and I'll talk to you again soon.